Okay, welcome back. So now that we have covered all the other parameters for risk check, we are left with the working capital issues. And this is something most new investors or most inexperienced investors, they miss out. Now, a business might be growing pretty well. It might be growing pretty fast. However, there may not be much cash that's being left over for the owners because maybe the business is eating up more and more working capital as it's growing. And let's see how that happens. So we start with this concept of debtors days, which is nothing but how many days on an average are the customers taking to pay the business. Let's take the example of General Motors. Now, we can see that in 2009, General Motors had an average of 29 days of sales outstanding, which means on an average, the customers were taking around 29 days to pay General Motors for the cars that General Motors were selling. Now see how this has gone up to 77 days in 2018. So clearly, Madam Mary Barra has some answering to do to the owners of the company, because General Motors is definitely not being able to collect its outstanding receivables as soon as they were being able to 10 years back. Inventory days is the next working capital item, which is again on an average how many days of inventory does the business need to carry. Another automobile company, Tata Motors, in 2009 it required on an average of 53 days of inventory, and that has shot up to over 80 days in the trailing 12 months. It's 86 days. So clearly, to generate that every dollar of sale, Tata Motors is being straddled with more and more of inventory, which is not a good sign. So that's another reason for me to not decide to look into deep into this company. Apple, fantastic company. In the past, I have been shareholders of Apple. However, their recent problems with their iPhone sales, it's not a hidden fact. We all know that Apple had to, for the first time in the history of the company, slash its prices in China, which is the largest smartphone market. And if we look at their inventory days, it has actually crept up from below 7 days. In fact, it was 3.26 days in 2012, and that has gone up to more than 3 times recently. So while the Apple bulls, they feel very good about Apple's growth in their service revenues, and that's a great strength that Apple has. It has the company has over 1.4 billion users, and because of that large ecosystem, the service revenues are growing, but clearly the product sales are facing some roadblocks, and even the inventory days, it's creeping up gradually. Accounts payable days. Now, this is nothing but how many days on an average it takes the business to pay its suppliers, vendors. Now, this tells me, the moment I look at accounts payable days, it tells me what's the negotiating power a business has. Think of a growing business which is constantly growing its sales volumes. That means it needs to order more and more raw materials from its suppliers, and with the increase in volumes, the increase in volumes gives them more negotiating power with the suppliers. So growing businesses often enjoy increasing account payable days. However, if you see that a business actually is losing its account payable days, then you immediately know that there is a problem. Sears Holdings, for example, it used to enjoy accounts payable days of almost 35-36 days in 2009 2010, and that has shrunk to 15 days. So it's very clear that the company does not have as much negotiating power with its suppliers as it used to have 10 years back. Cash conversion cycle is the time it takes a business to start from cash and end in cash. Now, in the course of business, a business starts with cash, then goes and buys some inventory, manufactures its products, sells some of the products while holding some inventory, and then it takes some time to collect the revenues. The customers sometimes take time to pay the business, and in the meantime the business also has to pay its suppliers, right? So once this entire cycle gets over, that is the cash conversion cycle. The formula is very simple. It's debtors days plus inventory days minus account payable days. And more efficient a business is, the lower is the cash conversion cycle, which means the business is being able to turn around its cash much faster. Now, again, we come back to General Motors. We see that just after General Motors came out of bankruptcy, it used to have a negative cash conversion cycle, which essentially meant the suppliers of the company, they were funding the working capital required for the business. So General Motors was paying its suppliers in 66 days, whereas it had below 30 days of debtors and about 38 days of inventory. So from that situation, the cash conversion cycle has worsened to over 38 days now, which means that General Motors over the last 10 years have become more inefficient. Now, some people might say, oh, that's the norm in the automobile industry, but that's not correct. Look at the competitor, Fiat Chrysler. They have actually become more and more efficient with the passage of time. In 2009, Fiat Chrysler had a cash conversion cycle of just about 6 days, and they have managed to bring it down to negative, and currently they enjoy a minus 26 days of cash conversion cycle, which means their operations are being completely funded. The working capital is being completely funded by its suppliers. That wraps up my framework for the quick risk check. Now, it's not necessary that you stick to exactly the same framework, but what's important is that you have some framework, some sort of process of quickly looking at a business and evaluating whether it's worth taking it to the next level, or whether you would just pass.